Buy-to-let mortgages can be a complete minefield, but they don't have to be. In this video, I want to talk about the 4 key aspects that you absolutely must understand when looking at buy-to-let mortgages here in the UK. If you're here for the first time, my name is Saj Hussain, and on this channel I share with you my knowledge and experience to help you get further faster in your property investing journey. First of all, a quick disclaimer. I can't give you any financial advice. What I'm going to share with you is my knowledge and experience around mortgages. Make sure you watch all the way to the end because I have a 5th bonus for you around buy-to-let mortgages. So first of all, what is a buy-to-let mortgage and how is it different from any other type of mortgage? So a buy-to-let mortgage is one that you would use to purchase investment property that may be occupied by your tenants. Whereas another type of mortgage, say residential, would be one that you use to live in yourself as your home. The important thing here to also remember is the FCA, or the Financial Conduct Authority, they regulate the residential mortgage sector. However, buy-to-let mortgages are unregulated. So why would you even want to consider using a buy-to-let mortgage? Well, a buy-to-let mortgage will give you the leverage to be able to purchase more than you can without. So what does that mean? Well, let's say you have £50,000 to invest in a property and you borrow the other £150,000 from a bank in the way of a buy-to-let mortgage. That now turns your £50,000 into £200,000 of purchasing power. Essentially, it's the leverage that it's giving you. It's also the most common way investors purchase property in this country, whether they're large investors, small investors, experienced investors, or unexperienced investors. Now, some people, of course, will just purchase for cash without any other borrowing at all, and that's a choice. But some people will want to maximize that cash and use the leverage that's available to you. So when we're looking at buy-to-let mortgages, as I mentioned earlier, there's 4 key aspects you need to think about. 3 of those are ones that the lender will want to particularly pay a lot of attention and detail to. The first one is you, the borrower. The second is that the property and the type of property you want to purchase or remortgage. The third item that they want to look at is the type of person or who will be living in the property and paying you the rent. And then the 4th thing that you need to be aware of is the different type of products that are available to you under buy-to-let mortgages. So let's look at those 4 in detail. The first is you as the borrower. The lender is going to be paying attention to you, the person that they're going to be lending the money to. Or it may even be your business, i.e. not you as an individual. This is very different to how it used to be many years ago, where you used to put a tie on and go and see the bank manager and sit there and present your case to them. These days it's all done online on application forms, and it may be you're speaking to an advisor in between. But ultimately you've got to present your best possible case in terms of why they should lend you this money. So one of the things that you need to do nice and early is make sure that you get your credit file in order. So you can download your credit file from various different agencies, make sure that's all in order, make sure all the things are paid as they should be, you're not borrowing too much against your credit already available to you, and essentially that you've got a good credit score. The other thing you want to do is review your bank statements over the last few months and look at the outgoings and the incomings on there and make sure it's tidy. So what I mean by that is so you've got a certain amount of income coming in and you're paying up a few things regularly, so you can see a pattern there in terms of you managing that money. Now, of course, this is assuming that you're going to be borrowing in your own name. But more recently, things have changed, and they've changed quite significantly because many borrowers now will borrow as a limited company as opposed to them as an individual. And the reason for that is because a few years ago, the government decided that they wanted to start taxing landlords in a different way. So what that means is that now we have to pay on the total rent roll tax on that as opposed to the net profit, which doesn't really happen in any other industry. This is essentially called Section 24. So what many landlords have now chosen to do and many investors have chosen to do is to purchase in a company because you can actually offset your interest as an expense, whereas now you no longer can do that in your personal name. So the way that we purchase has also changed. Now, this is something you need to sit down with your accountant to have a chat with them. Generally, if you're a small investor, if you've got a small number of properties and you're a lower taxpayer, you're fine in your own name. And those that are purchasing, say, 5, 6 or more properties, you probably need to be setting up and purchasing a limited company. I say probably because it's really important that you do speak to your accountant first of all. Although lenders don't primarily look at your income as a basis on how much they're going to lend you when it comes to purchasing buy-to-let property, it does take a factor with some lenders. So it's important all this information is organized, your pay slips, your P60s, if you're self-employed, you've got your SA302s, i.e. your tax returns. Usually it's 3 years that they ask for. It's not so important how much you earn, but it's important that you've got all this clearly documented, recorded, and it's all in order so that you don't have any delays at that stage. So the second factor, which is really important that the lender is going to be paying a lot of attention to, is the property itself. Now, if you're purchasing the property for the very first time, it will be seen as a mortgage. And if you already own that property, whether you purchased it for cash or you had a different mortgage on it or a bridge or whatever it might be, then it will be seen as a remortgage. And the way that the lender assesses the properties, they will send out a chartered surveyor to value the property and have a look at it. And of course, you'll be paying for that privilege. The report is produced for them, and the surveyor's job is to first of all make sure that the property there exists and it's not falling down, it's a fairly solid property. And there'll be a number of other things they'll be looking at as well. But primarily, they want to make sure that the security is safe, or what they call good security for the lender. So the rent is something that they'll be looking at, what the market rate is for that particular property. So for instance, if the market rate is say £500 for that particular property, and you think because you're going to do it up really nice, you'll be achieving £700, they will dismiss that and they will look at what the market rate is. Now, it's really important you do the research to check these figures, and it's very easy to do so because you can just jump onto Rightmove or Zoopla and look at the comparables there. And of course, if you can achieve a higher rent, that's great. And sometimes you can show a surveyor that what you're going to create will mean that your product that you're taking to the market will achieve a higher rent. And I've had many challenges like this with surveyors, particularly in our HMOs, when we have high quality properties and we charge premium rents. And when the surveyors see it for the first time, they're quite surprised that we're able to achieve such high rents. And sometimes they want to downgrade that to say, look, this is the market rate and that's what we want to assess it on, instead of what it is that you're actually achieving rent. You may have come across a term saying a property is mortgageable or even unmortgageable. And what they mean by that is that there's certain criteria the property meets. So for instance, with a buy-to-let mortgage, what the lender is doing is lending you the money to be able to purchase this property so that you can let it out and have some tenants living in there that can be paying you rent each month. And they expect that property to be ready to go and ready to live in, as opposed to needing a major renovation before it can be occupied. So what they'll be looking for is when they talk about a habitable property. So for instance, if you've got no running hot water in the house, they'd consider that a property that can't be habitable straight away, and you're not going to be able to generate a rent from it. So occasionally you'll see properties being advertised as unmortgaged. It might be it's been repossessed and somebody took the kitchen with them as they got repossessed with the property. And what that means is it leaves that property unmortgageable, i.e. it's not ready to occupy. So it's important that you're aware of these factors before the surveyor comes out, so you're not wasting time, and more importantly, you're not wasting money as well on applications that are not going to go anywhere. Other things to be aware of is the EPC ratings. There's a minimum EPC rating that you need to comply with. So because it's going to be rented out, you need to ensure the property is already compliant with these things. And if it's going to be a property for, say, single occupation, then it's important when the surveyor comes out that they look at the property, that it's not a HMO or it hasn't got 2 kitchens, it's not being converted to flats, because they're expecting to see a single family house if that's what you're purchasing and that's what the application is for. So it's important that the product matches that, and we'll talk more about that in a few moments. The third aspect that's key to the lender is the occupants in the property and what rent they'll be paying. So earlier we were talking about a family, single family occupying a property and the rent that they'll be paying. Now, if, for example, you're looking to use the house, say, as a HMO, then it's important that you've got the right mortgage product in place and not using the incorrect product, because that's going to cause you some problems, and we'll talk more about that in a short while. When they're looking at the rent, it's not just a case of that the rent needs to be enough to pay the mortgage, but there needs to be a buffer above that. So when they look at that buffer, that will vary from lender to lender, but often it will range from about 25% and above. So let's say your mortgage payments are £500 a month and you had a 50% buffer, if you like, above that. That will mean that they expect the rent to be £750, so you've got a 50% cushion. Now 50% is rare. Generally, if you're about 25% over, it's normally been the standard that many lenders will look for. The reason the lender is looking for a buffer, because they want to make sure that you can cover your other costs. Other costs, for example, will be the management that you might be paying for a letting agent. You might have some repairs you need to pay. You need to be able to cover voids. So they want to make sure that there's a little bit of a buffer there, that you can cover these things and you're not just about scraping by. Because ultimately, when we talk about buy to let, it's about generating income each month. It might not be a huge amount of income, but it should be generating some profit every single month. So we talk about the three aspects that the lender's going to be focused on. The fourth one is something that's going to be important for you to be thinking about, and that's the actual mortgage product itself. Now, I'm going to break this down into 7 steps, and I'm going to try and whiz through it because there's quite a lot to cover here. The first aspect to consider when we're looking at the product itself is if it's a mortgage or a remortgage. And I talked about this a few moments ago. This is an easy one because if you're purchasing the property, it'll be a mortgage. However, if you've got an existing property you already own, then it's a remortgage. A few things to bear in mind when you're remortgaging a property. You may come across something that's called a 6-month rule, and what that is the lenders are expecting you to have owned the property for at least 6 months before they allow you to take out a remortgage. There are some lenders that will be flexible about this, but this is generally the rule. So what that means is if you purchase a property from auction, say for cash this week, it doesn't mean that you can apply for a remortgage in, say, a month's time to be able to get that money back out. This is to prevent fraud and back-to-back sales. A lot of this used to happen in the last credit crunch, and what the lenders are doing, just tightening up on these things. Now, the second thing to think about is whether you'll be taking an interest-only mortgage or one that's a capital repayment. So let's talk about those for a moment. What's the difference between the two? Well, interest-only is really what it says on the tin. Each month you are paying the interest on that particular loan and not paying any of the debt. So for example, if you have a £100,000 mortgage and you're paying the interest on the £100,000 mortgage, at the end of the term of that mortgage, 20, 25 years, whatever it might be, you still owe £100,000. Now, if you've got a capital repayment mortgage, what that means is each month you're paying the interest plus a little bit extra towards the capital to pay down the debt. So at the end of the mortgage term, you've paid off the mortgage completely. Now, from what I've just said, the second one sounds much more logical to do. It means you're paying off the debt. However, when it comes to property investing, we take a slightly different approach. Because as I mentioned earlier, property investing is primarily about cash flow. It's creating an income. So if you're paying the interest plus an extra amount towards a capital, that probably will not leave you any money left each month as a cash flow, and in some cases it might even be negative, meaning you're putting your hand in your pocket to pay even more than you're collecting in rent. So generally speaking, most investors tend to focus on interest-only mortgages. Then of course you have to think about what happens when that mortgage term ends. How are you going to repay the debt? Because at that point the lender will say, can we have our £100,000 back please? So there's a few things that you can do. Some people will then sell the property at that point because, assuming, let's say it's 20 years time, will probably be worth significantly more than it is today. So it's enough to pay the debt and also be left with a substantial profit as well. Other things that people sometimes do is have other investments that they will then use those investments to pay the debt down on this particular property. But the most common thing that's generally done is a new mortgage is put in its place, i.e. it's remortgaged again, and the property will be worth significantly more, so it's very easy to borrow that amount of money or even more from the property to be able to repay the existing debt. The third aspect to think about when it comes to the actual product itself is the loan to value, the LTV. What's that actually mean? That means the percentage of money we're borrowing from the lender versus the purchase price. So let's say you're purchasing for £100,000 and you're borrowing £75,000 from the bank in the way of a buy-to-let mortgage, you're essentially 75% loan to value. So the typical loan to values many investors tend to follow is around the 75% figure. Some people want to be more low geared and more comfortable around the 60%. And occasionally some people want to go above the 75% when those products are available. So if you roll the clock back, say 10, 12 years at the height of the last credit crunch, if you like, pre-credit crunch, there were 95% buy-to-let mortgages available. However, these days lenders are a much more cautious breed, and generally speaking, 80 or even 85% is quite rare. So 75% tends to be the common figure. The other thing you need to think about is then how much of that is going to be your money. So i.e. the 25% that goes in needs to be your money. And it does need to be your money because the lenders want to check that you've got some skin in the game and that you haven't borrowed that money from somebody else. Because if you have borrowed that money, then technically speaking, it's 100% of other people's money and none of it's yours. Although there are some legal ways to structure deals like that, it's not so easy when it comes to buy-to-let mortgages. The next thing to take into consideration is the term of the mortgage. Now, typically mortgages will vary from 20, 25 years, but they can be shorter and they can be longer as well. So my preference is to go for a longer term mortgage, say 20 or 25 years, as opposed to say a 10-year only. The reason being, if it's an interest only mortgage, then that means if I change what I want to do in a few years' time, it's not too difficult to be able to remortgage and change that. Whereas if I'm committed to a 10-year mortgage, that means I have to do something at the end of that 10-year point or within that 10-year time frame. The fifth thing to take into consideration when we're looking at the product is the type of product that you're actually going to get. So what I mean by that is some mortgages will be fixed, some will be based on a tracker, and some will be variable. So let's look at those three in detail. The first one, which is a fixed mortgage, that means that the payments will be fixed for a period of time. Your monthly payments won't change. So it might be a 1-year fix, a 3-year, a 5-year, or even in some cases a 10-year fix. Now, your monthly payments not changing for say 3 years or 5 years gives you a huge amount of certainty to be able to plan ahead and knowing where you're going to be, which is one of the main reasons people like to choose a fixed type of mortgage. It also tends to suit a more cautious type of investor who doesn't really want the uncertainty of what the payments might be. Now, a tracker mortgage is one that generally tracks the Bank of England base rate. It can be tracking other things as well, but generally it tends to be the base rate. The base rate currently is 0.1%, so 0.1%, the base rate right now at the time of recording. But if you roll the clock back to say the early 80s, the base rate was 15%. So over the 40 years, there's been a massive variance in terms of the rates. So if you're somebody that likes a certainty, then a fixed rate is going to suit you, whereas a tracker will move as the base rates move. So right now you might be wondering where's the interest rates going to go. They're already at the lowest point. We don't really know. There's even talk of maybe negative rates coming into play at the moment as well. The last type is the variable. A variable is going on the bank's standard variable rate and just moving as that moves as well. So many of these products that we are looking at, say for example a fixed one, generally they tend to have what we call a discounted period or a honeymoon period where you're attracted by a headline figure. The headline figure will draw us into what those rates might be. With headline rates, sometimes they're discounted compared to the standard rate because what the lenders are doing are they're drawing us in with what looks like a really favorable rate. So for example, a discounted rate might be say 2% for the next 3 years fixed, and then it will switch to their standard variable rate, which might be say 4%. So when we're looking at the rates, it's important to look at it holistically and what the whole range will be in terms of what you're paying at the beginning, what it could be, what it will revert back to, sometimes called the revisionary rate. So after the rates, the seventh and final thing to consider is the true cost of the product. So what I mean by that, it's not necessarily just the monthly payments that you'll be making that you need to be thinking about. It needs to be that all other costs that you might incur in taking on the buy-to-let mortgage, holding the buy-to-let mortgage, and also bringing it to an end. So for example, some of the more common ones are when you take on the mortgage, you'll need to pay a valuation fee, as we talked about before. You most probably will have a product fee as well, where the lender is charging you a fee to enable you to have this particular mortgage, and they'll probably add that onto the debt of the mortgage as opposed to you having to pay as a cash payment. You might have a broker fee as well that you're paying. You may be a setup fee. There may even be an exit fee when you shut the mortgage down. But it's really important you're aware of all of these. Often they're all listed on one document when you get the mortgage offer, that you review them and understand all the different aspects of the cost so you can have a true comparison of what a mortgage is. So just relying on the headline rates isn't enough. Look, I hope you're enjoying this video. I'm going to share with you in a moment some bonus tips to think about when you're doing buy-to-let mortgages. But if you are liking this content, make sure you hit that like button and also subscribe to the channel and enable the notification bell, because I'm releasing 3 videos a week just to help you on your property investing journey and helping you get further faster. As a thank you for watching all the way to the end, I've got some bonus tips for you when looking at buy-to-let mortgages. The first one is make sure you use a whole of market independent mortgage broker to help you find the right products. For example, if you walk into your high street bank, you might have a great relationship with them, but they can only show you their products that they offer and not what's available on the whole market. If you're using an experienced broker, you'll be in a much better position. If you want some help with that, if you're looking for a great broker, make sure you ping me a message and I'll suggest a broker for you that you can use, and hopefully that will help you with that. The next tip is make sure your information that you're providing your lenders and your broker is 100% accurate, because there's a system called National Hunter. What that does is when lenders suspect something isn't quite right, they report information into this system, and if you've got an overlap of information that is a mismatch, that can be seen as fraudulent, and that can cause you massive problems when looking at mortgages in the future. So you want to make sure your information is 100% correct. With that in mind, make sure you give your broker as much information as you possibly can about what you're trying to do so that they can find the right products for you. It's not uncommon to find people taking out a mortgage product to purchase a property, a buy-to-let mortgage, then using it for something other than what it was intended for. So for example, some people may turn it into a HMO or run it as service accommodation, but the reality is you don't have consent to do that from your mortgage lender. So the terms and conditions will state that that's not something you can do. And essentially what that means is you're in breach of your mortgage terms, and the lender has the right to call in that mortgage, which will leave you in an enormous amount of problems. So it's really important that you're honest with your broker and they give you the right product for what it is that you're trying to achieve. When you're in need of a buy-to-let mortgage, a time frame can sometimes be critical, at other times it may not be so important. This is also something that you want to share with your broker so they can find not only the right product for you, but the lender that is working to those speeds. So for instance, you might be able to find a fantastic mortgage product and you need to complete on that property quickly because it's a great deal and you're under pressure to get the completion done. However, that lender is working at a very slow pace. A good broker will always be able to put a call into their BDM, their business development manager, for that particular lender and be able to assess what the service levels are at the moment so that they know what time frames that you're working to and finding you the right product. Another thing that you want to do nice and early, as I mentioned before, is to get your credit file, but not only from one agency, but all 3 UK credit reference agencies, so you've got the information and make sure it's consistent across all 3 of the credit reference agency reports. If there's anything slightly unusual about the property that you're purchasing or remortgaging, again, it's really important that you give as much information as you can to your broker so they can help you find the right products. Because one of the biggest mistakes people make is that they start off with a standard buy-to-let mortgage only to find that there's something different about that property and the product doesn't fit. Not only will you lose the time that you've invested, but also money in the process as well in terms of valuation fees and sometimes broker fees and things you've already paid. So for instance, if you've got an apartment or a flat conversion, which is say less than 30 square meters, then generally it's considered unmortgageable, but there might be some lenders that might do that. So again, by sharing that information, they can help you with that. Another example is if it's a building is what's called non-standard construction. i.e. it's not made of bricks and mortar and tiles, it's got some different type of construction. It could be timber construction, it could be concrete. Look, I hope you find this video useful. It gives you some suggestions and help around buy-to-let mortgages. If you are, make sure you hit that like button. As I said, let me know in the comment section if there's anything else I can help you with. I try and read all the comments and be able to answer those as well for you. I release 3 videos a week. As I said, make sure that you look out for those on the YouTube channel, and I look forward to seeing you again on the next video.